These are the retirement savings benchmarks by age that most financial advisors actually use, set against where most Americans genuinely land when you look at the real numbers. If you are between 45 and 65, have a Roth IRA, or are trying to figure out whether you should, this video covers real targets, real dollar amounts, and real strategies you can act on. A Roth IRA runs on after-tax dollars, meaning you pay taxes before the money goes in, and everything that grows inside the account from that point forward comes out completely tax-free. In retirement, every dollar of compounding, every dividend reinvested over the years, none of it gets taxed again when you withdraw it. That is the whole mechanic, and it is a more powerful one than it sounds. Here's why the timing piece matters so much for people in this specific age range. Right now, the Tax Cuts and Jobs Act of 2017 lowered tax rates for most Americans, but those individual provisions are scheduled to expire after the 31st of December, 2025, and if Congress doesn't extend them, the brackets revert to pre-negative 2018 levels. For a lot of middle-income earners, that means the 22% bracket could flip back to 25%, and that is not speculation. That is the current law in the books. Contributing to a Roth during a lower rate period locks in your tax payment at today's rate, and everything that grows from there stays permanently out of the IRS's reach. That combination of a tax expiration deadline and the long runway of tax-free compounding is what makes this moment different from most years, and it is worth treating it that way. For 2025, the annual Roth IRA contribution limit sits at $7,000 for anyone under age 50, and once you cross that birthday, a catch-up provision bumps your ceiling to $8,000 per year. That additional $1,000 gets more interesting when you factor in what the Secure 2.0 Act changed in late 2022. Starting in 2024, that catch-up amount begins tracking with inflation going forward, which means it won't stay frozen at $1,000 the way it did for nearly 2 decades. Income limits are the other wall to know about. Single filers start phasing out of direct Roth contributions at $150,000 in modified adjusted gross income for 2025, and the ability to contribute disappears entirely above $165,000. Married couples filing jointly hit the phase out range between $236,000 and $246,000. And 2026 thresholds should be confirmed at irs.gov once released, which the IRS tends to do in October or November of the prior year. But hitting those income ceilings doesn't actually lock you out. And this is where a lot of high earners leave real money on the table. The backdoor Roth strategy, making a non-deductible traditional IRA contribution and then converting it to Roth, has been available since 2010, when Congress removed income limits on Roth conversions entirely. A CPA or CFP can walk you through whether it applies cleanly to your situation. And if your employer offers a Roth 401k, the income limits don't apply at all. The 2025 contribution limit runs to $23,500. And for anyone aged 60 through 63, Secure 2.0 introduced an enhanced catch-up that allows an additional $11,250 on top of that in a workplace plan. Most people in that age window have no idea that provision exists. Fidelity Investments publishes the most widely referenced age-based retirement benchmarks, built around multiples of your annual salary, and the framework looks like this. By 40, the target is 3 times your annual salary saved across all retirement accounts. By 45, 4 times. By 56 times. By 55, 7 times. By 68 times, and by age 67, the full retirement target reaches 10 times your annual salary. Fidelity builds these figures on a specific set of assumptions: that you began saving at 25, that you are putting away 15% of income each year, that more than half your investments sit in equities, and that you plan to retire at 67. Running those multipliers against the Bureau of Labor Statistics reported median weekly earnings of approximately $1,139 for full-time workers in the fourth quarter of 2024, which annualizes to roughly $59,000, gives you a concrete dollar anchor. At age 50, the benchmark points to somewhere between $355,000 and $390,000 in total retirement savings. At 60, that range climbs to roughly $470,000 to $520,000. Now compare that to what the Federal Reserve's survey of consumer finances actually found. Americans aged 55 to 64 carried a median retirement account balance of approximately $185,000, and the Fidelity benchmark for that same age group sits at 7 to 8 times salary. For a median earner, that translates to $413,000 to $472,000. That means the person sitting exactly in the middle of the American retirement savings distribution holds less than half of what the benchmark calls for at that age. And that figure comes from documented survey data, not an estimate. Vanguard's 2024 How America Saves report sharpens the picture further. The average 401k balance across all ages came in at $134,128, but the median collapsed to $35,286. A spread that shows how heavily a small number of large balances pull that average upward. To get specific about the Roth IRA piece on its own, consider what consistent maximum contributions produce over time. Someone who started putting in $7,000 per year at age 22 and earned a 7% average annual return. A conservative long-term projection used widely in financial planning would arrive at each age milestone, carrying very different balances. By age 40, that account holds approximately $220,000 to $240,000. By 45, the range moves to around $345,000 to $375,000. By 50, it crosses $515,000. By 55, it approaches $800,000. And by 60, compounding pushes it past $1 million, roughly $1,050,000 to $1,100,000. These figures are projections, not guarantees, and actual results depend on contribution timing, market performance, and whether limits shifted in a given year. But the number that tends to stop people is this one. A single $7,000 contribution made at age 22 compounds to approximately $147,000 by age 65 at 7% annual growth. 1 year's contribution, held long enough, multiplies by a factor of 21. The math doesn't care about motivation or intention. It rewards people who started early and charges everyone else a compounding penalty for every year of delay that most people don't fully register until they're staring at a gap between where they are and where the benchmark says they should be. Being behind the benchmark puts you in the majority of Americans. And that is worth stating directly, because the worst response to a savings gap is paralysis. And the second worst is waiting for a better year to start. The catch? Up playbook for people in the 45 to negative 65 range has more tools than most people realize. The most straightforward one, if you are 50 or older, you are already eligible for $8,000 per year in Roth IRA contributions instead of $7,000. And over 10 years at 7% growth, that additional $1,000 annually compounds into a cushion that meaningfully changes the trajectory. The second tool lives inside your workplace plan. For anyone between 60 and 63, Secure 2.0's Enhanced Catch Up allows $11,250 in additional contributions, on top of the standard $401k limit, and this remains one of the least used provisions in recent retirement law. Roth conversions open a third path, and this one gets interesting during lower income years. Converting money from a traditional IRA or old 401k to a Roth triggers ordinary income tax on the converted amount in the year it happens. But from that point forward, the money grows tax-free permanently. That strategy works best during gaps between jobs, early semi-retirement, or any year when income runs lower than usual. The fourth tool is the spousal Roth IRA, which allows a non-working or lower earning spouse to contribute up to $7,000 or $8,000 each year, based on the working spouse's earned income, effectively doubling a household's annual Roth contributions without requiring two separate incomes. And the fifth approach costs nothing in terms of current lifestyle. Directing raises or bonuses straight into a Roth account means you're not cutting back on anything you were already spending. You're routing new money into a tax-free structure before it gets absorbed into daily expenses. A real debate runs through financial planning circles about whether Roth is always the right call, and skipping over it would leave out something worth understanding. Traditional IRAs and 401k deliver a tax deduction upfront. You contribute pre-tax dollars, reduce your taxable income now, and pay taxes on withdrawals in retirement. The Roth flips that structure entirely, and which approach works better depends on whether your tax rate runs higher now or in retirement. For high earners in peak earning years, some planners make a credible case for putting more weight on the traditional deduction. But here's the thing, retirement taxable income tends to surprise people in ways that favor the Roth side of the ledger. Social Security benefits become at least partially taxable above certain income thresholds. Required minimum distributions from traditional accounts force taxable income higher, whether you need the money or not. Medicare premiums are income tested, meaning higher retirement income directly triggers higher premiums. All of those factors can push the real tax cost of a traditional heavy strategy well above what the original deduction was worth. And that is a calculation a lot of people don't run until they're already in retirement. Roth accounts carry no RMDs during the account holder's lifetime, a rule that extended to Roth 401k starting in 2024 under Secure 2.0, removing a long-standing disadvantage those accounts carried relative to Roth IRAs. The strongest argument here isn't Roth versus traditional. It is holding both types of accounts, so you carry real flexibility in retirement to control how much taxable income you generate in any given year. That flexibility has dollar value that is hard to calculate in advance, but tends to grow more useful the longer you hold it. The Roth IRA has existed since 1998, named for Senator William Roth of Delaware and created by the Taxpayer Relief Act of 1997. And for nearly 30 years it has been one of the most powerful tax advantage tools available to ordinary American savers. Only about 14 to 16% of eligible taxpayers max it out in any given year. And the gap between what those accounts can produce over time and what most people actually hold in retirement savings at 55 or 60 is one of the sharpest contrasts in personal finance. The benchmarks covered in this video are clear. The compounding math behind them doesn't negotiate, and the window created by the potential TCJA sunset runs narrow. Being behind the Fidelity multiplier at your current age doesn't mean the outcome is fixed. The catch: up rules, the spousal IRA provision, the Roth conversion pathway, and the Roth 401k enhanced contributions all exist for people who are doing this math later than they planned. What those tools can't do is work on your behalf while you're waiting. Before changing anything about your accounts, talk to a CFP or CPA who can look at your actual income, your existing account mix, your tax situation, and your timeline. Because every general principle in this video needs to run through your specific numbers. But the first step is knowing where the target is, and now you do. If this video helped clarify where you stand, share it with someone running the same math, and check the description for links to the IRS contribution limit page and Fidelity's benchmarks, so you can apply the numbers directly to your own situation.